Welcome to the Deep Dive. We're here to cut through the noise and get straight to the core insights on, well, some pretty fascinating topics.
Think of it as your shortcut to getting up to speed quickly, hopefully with a few aha moments thrown in.
Right, without the information overload.
So today, we're diving deep into a really interesting story. It's about corporate strategy, evolution, and the growing world of digital assets.
Exactly. We're looking at the company now called Strategy, ticker MSTR. We've got a detailed investment thesis document from ChrisMMillas as a key source.
And we're also weaving in some perspectives from the Bitcoin Doctor newsletter, which talks about Bitcoin's wider role, especially for businesses.
Yeah, so our mission today is to really unpack Strategy's, frankly, very bold bet on Bitcoin. We want to get inside their strategic thinking.
Understand the potential opportunities, obviously.
And the risks, too, absolutely.
Yeah.
We need a clear view of the risks and see how this all fits into the bigger picture of digital finance, from a business and investment angle.
Should be some good insights. Those moments where things just click.
Hopefully. So let's start with the basics. Strategy itself. Maybe not everyone knows the history, especially the old name.
Good point. They were MicroStrategy until February 2025, founded way back in 1989 by Michael Saylor.
Right. And for most of their history, they were known as this largest publicly traded analyst software company. Business intelligence, data analytics.
Yeah, helping companies make sense of their data. They were even public during the dot-com boom. Went through some ups and downs.
Definitely weathered some storms, like those accounting issues back in the early 2000s.
But they adapted, right. Mobile cloud analytics stayed relevant in that BI space for decades.
Absolutely. But then 2020 hit, and that seemed to be the real pivot point.
A major turning point, driven, as the sources suggest, by concerns about inflation, the stability of traditional fiat currencies.
Like the U.S. dollar, which would be printed more, potentially losing value.
Exactly. So they made this pretty dramatic move, adopted Bitcoin as their primary treasury reserve asset.
And not just a small allocation. This became like the core of their entire financial strategy.
A fundamental shift. It really changed the identity of the company.
Which was then cemented by the rebranding in early 2025, wasn't it? Shortening the name from MicroStrategy to just Strategy.
Yeah, signaling that ambition. They talk about becoming a global Bitcoin bank. That's the vision.
The leadership structure changed, too, to reflect this.
Right. Michael Saylor, the founder, moved to executive chairman. His focus, purely the Bitcoin strategy.
While Fong Li took over as CEO, managing the ongoing, the traditional BI software business.
So like two distinct engines within the one company, really.
Okay, so let's get into the meat of it. Yeah. The investment thesis itself, based on that Millis document. What's the core idea driving this whole thing?
At its heart, it's actually pretty simple conceptually.
Okay.
Strategy buys Bitcoin. They hold Bitcoin. And critically, they leverage Bitcoin, all with the goal of growing shareholder value. It's not passive holding.
Right. And the thesis lays out a two-phase model for this.
Yes, exactly. Phase one is all about accumulation.
Accumulate.
The main goal here is just maximizing how much Bitcoin they can get their hands on.
And how do they do that?
By using the capital markets, raising money, debt, equity, basically any way they can strategically to buy more Bitcoin. So really aggressively acquiring it, betting on future price increases.
Okay, that's phase one. Accumulate. What's phase two?
Phase two is monetization.
Monetization. Makes sense.
Once they've built up this massive Bitcoin stash, the focus shifts. How can they generate cash flow from those holdings?
So moving from just buying it to actually using it to make money.
Precisely. Developing financial products, services, leveraging the asset itself. This phase, if successful, could mean new revenue streams, boosting cash flow, benefiting shareholders directly.
And there's this narrative woven through it. The idea of strategy, creating a corporate monopoly on Bitcoin. That sounds strong.
It's definitely assertive. The thesis points to Saylor's own words about wanting to own dominant technology monopolies that everybody needs, nobody understands, and are unstoppable.
Wow. So the idea is Strategy becomes the go-to public company for large-scale Bitcoin exposure.
That seems to be the aim, positioning themselves as unique in that respect.
Which brings us to competitive advantages. What makes them think they can pull this off? What's their moat?
The Millis thesis points out a few things. There's the cult aspect, this really strong belief from investors in Bitcoin and in Saylor's strategy.
A loyal following, basically.
Yeah. Then first mover advantage. They went big and early. The flywheel concept, which we should unpack.
Definitely.
And this idea of a winner takes most dynamic in this space.
Interesting. Okay, so what about the actual economic mode? What gives them that long-term defensibility?
Several elements are listed. Brand recognition, they're now synonymous with corporate Bitcoin. Monopoly, as we said, in terms of being the biggest public holder.
Uh-huh.
Optionality, having all that Bitcoin gives them strategic choices later. Visionary leadership, Saylor's role is seen as key. And kind of weirdly, volatility.
Volatility as a moat, how does that work? That sounds more like a risk.
It's counterintuitive, right? But the argument is they use the volatility, especially with things like convertible bonds.
Okay.
The swings in their stock price, which is tied to Bitcoin's price, create opportunities. Opportunities to convert debt cheaply or issue new debt when terms are good because of that volatility.
So they're trying to turn the volatility itself into a tool.
That's the idea.
Yeah.
Leveraging it in the capital markets in a way others maybe can't or won't. It requires sophistication, I guess.
Right. Okay, let's talk about those flywheels. There are two main ones mentioned.
Yes. First, the leveraging capital markets flywheel.
How does that one spin?
Okay, so strategy raises capital. They use it to buy Bitcoin if Bitcoin's price goes up.
Their holdings are worth more.
Exactly, which boosts strategy's market cap. A higher market cap makes it easier to
Raise more capital.
Right, and then they buy more Bitcoin, potentially pushing the price up further, increasing the market cap again. You see the cycle.
Yeah, it feeds on itself.
Yeah,
Potentially very powerful if it keeps working.
potentially. The second flywheel involves market index inclusion.
Ah, like getting into the S&P 500 or similar indexes.
Exactly. As they get bigger, they might get included in major indexes. That forces passive investment funds, index trackers, to buy their stock.
Which pushes the share price up.
Which again helps them raise capital, buy more Bitcoin, which might increase Bitcoin's price, make strategy's market cap even bigger,
Leading to a larger weighting in the index.
and attracting even more passive money. The thesis even says, boldy, strategy doesn't need indexes, indexes need strategy.
Huh. That's quite a statement. The idea being they'll become too big and important not to include.
That seems to be the implication. Their Bitcoin holdings become a significant asset class representation that indexes can't ignore.
And back to the monopoly idea. Why couldn't competitors just copy this?
The thesis argues there are significant barriers. First, the sheer amount of capital required. Few companies have that. Second, you need a CEO, a leader, with extreme conviction willing to bet the company on Bitcoin. That's rare. Saylor's control and voting power are key there.
Right. His commitment is unique.
And even if competitors did jump in now, their buying would push up Bitcoin's price.
Which benefits strategy because they already hold so much.
Exactly. It helps strategy raise even more capital relative to the newcomer. Plus, smaller companies can't operate at this scale, and big established companies usually have core businesses they need to protect. They can't just become a pure Bitcoin play like strategy.
Makes sense. Okay, so how do we track if this is actually working? What are the key performance indicators, the KPIs?
The thesis highlights three main ones. First, Bitcoin yield.
Bitcoin yield.
Yeah, it's the percentage change in Bitcoin per share over time.
Ah, okay. So the second KPI is probably Bitcoin per share itself.
You got it. Total Bitcoin owned divided by the total number of diluted shares out there.
And the key here is accretive dilution.
Right. Crucial. It means they're increasing their Bitcoin holdings faster than they're issuing new shares. So even though there are more shares, each share represents a growing amount of Bitcoin. That's the goal.
That's a really important distinction. And the third KPI?
Simply, total Bitcoin holdings. The sheer number of coins they own.
And they get audited, right, to prove they actually have the Bitcoin.
Yeah, the thesis mentions third-party audits acting as proof of reserves, transparency.
Good. So tracking those three Bitcoin yield, Bitcoin per share, and total holdings tells you how the accumulation strategy is going.
Exactly. They directly measure the core thesis in action.
Okay, so given this framework, what are the big opportunities this strategy opens up for strategy?
Well, the biggest one is achieving that vision, becoming a true Bitcoin treasury company, where managing and leveraging Bitcoin is the core business.
And the thesis argues against them, trying to time the market, buying the dips, that sort of thing.
Strongly argues against it, cites Saylor probably having better info, the huge risk of missing Bitcoin's big rallies if you're trying to be clever. Plus, investors want predictability in the strategy, and fundamentally, Saylor's playing a very long-term capital allocation game. He's not day trading.
Right. So how does strategy stack up against other ways someone might invest in Bitcoin? Like, say, a Bitcoin ETF.
The thesis makes a strong case for Strategy's advantages. One, they're the biggest corporate holder, period.
Okay.
Two, they use financial leverage, debt, etc., to potentially amplify Bitcoin exposure beyond just holding Bitcoin directly.
So potentially more upside.
Potentially. Three, they generate yield not just from price going up, but from that Bitcoin per share growth we talked about.
Right, the accretive dilution.
Four, no management fees like you'd get with many funds or ETFs. Five, they act as an international gateway for investors who maybe can't easily buy Bitcoin or US ETFs.
Interesting point.
Six, their stock is very liquid, big options market around it. Seven, the potential index inclusion benefits we discussed. And eight, the ultimate goal, becoming that Bitcoin bank, offering Bitcoin with benefits, as they call it, Eurobuy.
Bitcoin with benefits? Catchy. But it's crucial, as the thesis notes. Owning MSTR stock doesn't mean you own the actual Bitcoin.
Absolutely. Critical distinction. You own shares in the company that holds the Bitcoin. It's an indirect exposure.
The document also differentiates between owning raw Bitcoin versus wrapped Bitcoin through strategy stock. What's the thinking there?
It's about investor motivation, really. Raw Bitcoin, holding your own keys, is for people who value self-sovereignty, direct control, maximum decentralization.
Okay.
Wrapped Bitcoin via MSTR stock is more for those focused purely on financial return, the ROI. They're comfortable with strategy, holding the keys, managing the strategy, using leverage, different goals, different tools.
Got it. So let's dig into how they fund all this Bitcoin buying. It's clearly not just coming from the software business profits.
Oh, definitely not. They're actively using their balance sheet and tapping the financial markets. As their Bitcoin goes up in value, generally their borrowing capacity increases too. That flywheel again.
So what are the main tools, the capital levers they pull?
The thesis highlights four main ones. Traditional debt, like regular loans or bonds.
Okay.
Convertible debt, which seems really important for them.
We should definitely talk more about those.
Agreed. Then, equity issuance, selling new shares of stock. And finally, at the market, or ATM offerings, which is a way to sell shares gradually into the market. Saylor seems a bit cautious with ATMs, maybe to avoid hitting the stock price too hard.
Right. Okay, let's focus on those convertible bonds. They seem key. What exactly are they, and why are they so suited to Strategy's plan?
So a convertible bond is kind of a hybrid. It starts as debt. The company borrows money, pays interest.
Like a normal bond.
Right. But it has an embedded option. The bondholder can choose at some point to convert that debt into a fixed number of the company's shares.
Ah, so debt that can become stock.
Exactly. The price they convert at, the conversion price, is set when the bond is issued. Factors like interest rates, the company's creditworthiness, its stock price, and importantly, its volatility, all influence how these bonds are priced.
Higher volatility makes the conversion option more valuable.
Generally, yes. And crucially, when the bonds are converted into stock, the debt disappears from Strategy's balance sheet. Poof, liability gone.
Okay, I see the appeal. So how does Strategy specifically benefit from using these?
Well, first, it's often seen as less immediately dilutive than just issuing stock outright, although there's potential dilution later if they convert.
Right.
Second, it attracts a certain kind of investor, someone who wants some potential Bitcoin strategy upside, but also the downside protection of a bond if things go south.
Sort of captures both worlds.
Kind of. And the thesis emphasizes there's been huge demand for Strategy's convertible bonds, suggests the market is hungry for yield, and maybe sees this as an attractive way to get Bitcoin exposure.
Almost a desperation for yield in the bond market, it says.
Yeah, that phrase is used. They even float the idea of potentially issuing zero coupon or even negative coupon bonds in the future.
Wow, investors paying them for the option.
Theoretically, if the conversion option is valuable enough.
And Strategy's unique position comes from having so much Bitcoin already.
Exactly. That huge pile of Bitcoin implicitly backs their debt, making their bonds potentially more attractive and allowing them to issue large amounts, maybe on better terms than others could.
The thesis mentions insurance companies might prefer these bonds to holding Bitcoin directly.
Right, because of accounting rules. Holding Bitcoin directly might force write-downs if the price drops, affecting their regulatory capital ratios. Strategy's bonds might avoid that issue for them.
Interesting regulatory angle. And apparently these bonds have performed well.
Yeah, the document notes that many of their past convertible issues have actually outperformed Bitcoin itself since issuance.
Okay. What about their overall debt level? Do they have a target?
They aim for a relatively low leverage ratio, around 25%. They see that as prudent.
And when bonds convert to equity, that leverage ratio drops.
Typically, yes. And if it falls below their 25% target, that might be a signal to them.
Right.
Hey, maybe it's time to issue more debt, buy more Bitcoin, keep the flywheel spinning.
Makes sense. What about the other levers, preferred stock and ATMs? What role do they play?
Preferred stock is another hybrid kind of between debt and common stock. Pays a fixed dividend, has priority over common stock if things go bad, but usually no voting rights. It's another way to raise capital without diluting voting control.
Okay.
ATMs, as we said, are about selling common stock gradually, less disruptive than a big offering. It raises equity, strengthens the balance sheet, which can then support more debt issuance, like convertibles, down the line. Saylor seems to use them when the stock price looks strong.
And a really critical point mentioned is that their Bitcoin holdings are unencumbered. What does that mean, and why is it so important?
Hugely important. It means the Bitcoin is not pledged as collateral against their debt.
Okay.
So if Bitcoin's price crashes, lenders can't force them to sell their Bitcoin to cover the loans. There are no margin calls on the Bitcoin itself. It gives them maximum flexibility and avoids forced selling at the worst possible time.
That seems like a massive strategic advantage. Okay, let's circle back to that Bitcoin Bank vision. What would that actually look like?
The idea is, with all this Bitcoin, they can start offering financial products backed by it. Lending, perhaps custody, maybe other services.
Using the Bitcoin as the foundation.
Exactly. The thesis even plays with some numbers, estimating potential cash flows based on generating a yield from their Bitcoin holdings. It connects this to ideas from early Bitcoin pioneers like Hal Finney and, of course, Saylor himself.
Didn't Saylor say something about becoming the Amazon of fixed income?
Yeah, that ambitious quote is in there. Suggests wanting to use Bitcoin collateral to become a dominant player in the bond market somehow. Big vision.
Very big. We also mentioned the index inclusion flywheel. Any other potential future opportunities highlighted?
One really interesting one is the idea of a strategy stablecoin.
A stablecoin, like Tether or USDC.
Similar in goal, maintaining a stable value, say $1, but different in design. This would be over-collateralized with Bitcoin.
Meaning they'd hold more than $1 worth of Bitcoin for every $1 stablecoin issued.
Precisely. The potential advantages listed are institutional-grade custody, Strategy's brand recognition, using their huge Bitcoin reserves for liquidity, potentially navigating regulations better as a public company, and crucially, being backed by Bitcoin, not fiat currency or algorithms.
Which might be appealing given concerns about traditional stablecoin reserves.
Exactly. But they also note challenges. Regulatory hurdles are still huge for stablecoins, and maintaining that peg perfectly is always tricky. They specifically contrast it with algorithmic stablecoins, which have often failed, and fiat-backed ones, especially thinking about potential future regulations on reserves.
Okay, that's definitely one to watch. Now, what about the idea of Strategy acting as bear market protection for Bitcoin itself? Does their buying prop up the price during downturns?
The thesis is pretty skeptical about that, calls it unlikely to offer major protection. Basically, while their buying helps, it argues that wider market psychology, fear and greed, and big global liquidity flows are much bigger drivers of Bitcoin's price. Strategy's buying is significant, but maybe not enough to overcome a major panic or liquidity crunch. Plus, a lot of MSTR stock is held by retail, who might panic sell too.
Fair point.
Yeah.
Okay, essential part of any analysis. The risks. What are the big ones?
Three main ones stand out. Number one, a Bitcoin extinction event. Like the network catastrophically fails, game over, highly unlikely, but the ultimate risk.
Right, the black swan.
Number two, a really prolonged, severe crash in Bitcoin's price. Not extinction, but way down for a long time. This could force them to issue stock at really low prices to repay debt when it comes due, which would be very dilutive to existing shareholders.
Damaging the Bitcoin per share metric.
Severely. And number three, custodial failure. Losing their Bitcoin hacking, theft, internal frauds, some operational disaster, losing the core asset.
Those are definitely major risks. Any others mentioned, even if lower probability?
Yeah, a few others. Risk that volatility dries up, making their convertible strategy less effective. Risk that demand for their future Bitcoin bank services is low.
Yeah.
Regulatory risk, new rules hitting Bitcoin or their specific model. Counterparty risk with their lenders. The very unlikely Executive Order 6102 risk government seizure, like with gold in the 30s.
Okay, that feels remote for Bitcoin, but technically possible, I guess.
Also, the risk that capital gains tax on Bitcoin gets eliminated, making direct ownership relatively more attractive. And finally, key man risk.
Losing Michael Saylor.
Right. Though the thesis argues this might be overstated now because the strategy is so clear and shareholder interests are aligned, but still, he's obviously central.
Definitely. Let's talk more about Saylor and the team. The thesis really focuses on his leadership.
It does. Starts by noting founder-led businesses often outperform, then traces Saylor's history. Founding the company in '89, the '90s growth, surviving the early 2000s crisis, rebuilding.
He's been around a long time.
Calls him a visionary, credits him with a potentially unmatched understanding of Bitcoin. Shares some personality tidbits, intense focus, reads constantly. The $1 salary since 2014, though his compensation comes from other sources, mainly stock.
Longest reigning CEO of a public software company, apparently. And survived that huge stock crash back then.
Yeah, shows resilience. The thesis even tries to map him to the big 5 traits of innovators: openness, conscientiousness, disagreeableness, IQ, low neuroticism. Suggests he fits the profile.
Interesting framework.
Ultimately paints him as internally driven, long-term focused, huge skin in the game, with his own holdings, acting for shareholders, detail-oriented, innovative, mission-driven, rational, candid.
Quite the list.
And concludes the management team generally shows leadership, integrity, intelligence, energy, resists doing dumb things just because other companies do them, has incentives aligned with shareholders, and tends to underpromise and overdeliver. High praise.
Okay. What about the company culture beyond the leadership?
Highlights a strong culture. Uses an old anecdote from 2000 about Saylor chartering a cruise ship for the entire staff.
Wow, really?
Yeah, suggesting a commitment to morale and unity back then. Also mentions how using equity, like stock options and RSUs, helps attract and retain talent, aligning everyone with the long-term vision. Performance bonuses, too.
Seems like a culture built around that core mission now.
Okay, valuation. Always the tricky part. How does the thesis suggest thinking about strategy's market cap?
It offers a simplified framework.
Yeah.
Think of the market cap as the current value of all the Bitcoin they're expected to hold in the future.
Okay.
Minus the cost of acquiring all that Bitcoin.
Right, the capital expenditure.
Plus the present value of any future cash flows they might generate from that Bitcoin, like from the Bitcoin bank idea.
And then maybe a premium on top.
Yeah, potentially a premium for that perceived monopoly status and for Saylor's leadership.
And it emphasizes valuing them in both dollars and Bitcoin terms. Yes, separately. Noting that in fiat terms, if the dollar keeps losing value, the premium can get quite large. It quotes, "Strategy has no ceiling because the dollar has no floor."
Techie.
A key point is that future yield and cash flows from Bitcoin deserve a multiple, but just hoping the Bitcoin price goes up shouldn't get a multiple on top of the NAV.
Avoid double counting the price appreciation.
Right. It also notes that a high NAV multiple actually helps their Bitcoin yield strategy, weirdly enough.
How so?
Because if their stock trades way above the value of the Bitcoin they hold, they can issue fewer shares to buy the same amount of Bitcoin, boosting Bitcoin per share faster.
See, the high multiple becomes a tool for accumulation.
Exactly. The thesis suggests a high potential range for future value, acknowledging the long-term potential. Mentions past share buybacks, too. Calls the risk asymmetrical, more potential upside than downside.
And quotes Bill Miller IV again about being in the very early innings of a massive capital repricing event.
Yeah, framing Bitcoin and strategy as potentially big beneficiaries of that shift.
Okay. The thesis wraps up with some key summary points and then tackles common criticisms, the FAQs or qualms. What are the final takeaways?
Reiterates the core thesis is simple. Belief in Bitcoin adoption plus strategy keeps accumulating. The elevator pitch. Strategy, monopoly on the hardest commodity in the biggest asset class.
Concise.
Says the thesis is expanding over time. Estimates the chance of permanent capital loss is very low, like 2%. Author rates their own understanding at 9/10.
Confident.
Claims the edge is understanding that the market hasn't fully grasped Bitcoin's impact or strategy's role yet. Strong personal alignment and intuition, also 9/10. Stresses independent thinking, avoiding groupthink.
Important.
The final verdict is must own, citing principles from Munger and Miller about concentrating on great companies and betting big. Belief strategy will likely still be around and thriving in 25 years, the Lindy effect. Comfortable holding for 10 years, confirms it's within their circle of competence.
Okay, a very bullish conclusion. Now, how does it handle the common criticisms, those frequently amplified qualms?
The main counter-argument to almost everything is, Saylor is the largest shareholder. His incentives are aligned.
Okay, but specifically, like strategy is a Ponzi scheme.
Refuted by comparing it to leveraged real estate investing. It's a leveraged holding company, not a Ponzi.
Strategy is a scam.
Countered by framing it as transmuting devaluing fiat into appreciating Bitcoin, which actually helps Bitcoin adoption.
What about comparing it to a closed-end fund, saying just buy a Bitcoin ETF?
Argues strategy offers amplified Bitcoin exposure via leverage and BPS growth, plus the other benefits. No fees, international access, options, bank potential, quotes Bill Miller IV supporting this view.
Okay, you should just buy Bitcoin directly.
Acknowledges it's a valid choice for self-sovereignty, but MSTR is optimizing for ROI. Different goals, different trade-offs.
The software business is trash.
Dismissed as irrelevant to the Bitcoin strategy's success. The Bitcoin plan doesn't depend on software profits, and there are no bond covenants tied to it.
What about Saylor has been selling shares?
Explained as exercising old options from 2014 that were expiring. Reiterates the $1 salary since then. Basically, planned compensation, not losing faith.
And the big one, strategy will get liquidated if Bitcoin crashes.
Argues the unsecured convertible debt gives flexibility. In a worst-case scenario, debt would likely convert to equity, heavy dilution, yes, rather than forcing Bitcoin liquidation. The structure is designed to avoid that.
Okay, that covers the strategy thesis in detail. Now, let's switch gears slightly to the Bitcoin Doctor newsletter. What's its main focus?
Its core mission is really interesting, empowering small businesses to do what strategy did adopt Bitcoin as a treasury reserve asset.
Taking the strategy model down to the small business level.
Exactly. Framing it as a new era for Bitcoin, moving beyond just individuals and huge corporations, making the strategy accessible.
What benefits does it highlight for these small businesses?
3 main things. Protecting wealth from inflation. Potential for significant asset growth. It cites Bitcoin's historical CGR, something like 68% from 2015 to early 2025.
Wow,
Historically, yes. And third, simplicity. The newsletter aims to demystify it, make it doable, even without being a crypto expert.
What kind of impact could this have if lots of small businesses actually did this?
The newsletter calls it potentially game-changing. There are hundreds of millions of small businesses globally.
332 million, it estimates.
Yeah. So even a small fraction adopting Bitcoin treasuries could mean huge inflows, sparking a real grassroots Bitcoin economy.
Could that influence bigger companies or even governments?
That's the idea. A ripple effect upwards. Could provide stability in regions with weak currencies. Might even push governments towards things like a strategic Bitcoin reserve, maybe in the US. Big picture thinking.
So what does the newsletter actually provide to help businesses?
Practical stuff, starter kits, guidance. Insights inspired by Saylor. It mentions his 21 Truths of Bitcoin, tips on tax and legal issues for businesses holding Bitcoin. And it aims for global reach, offering content in 6 UN languages.
Trying to be a practical resource. Does it also cover Bitcoin fundamentals?
Yes. It emphasizes the basics. Provable scarcity, that 21 million limit, appeals to different groups. Retirees, inflation hedge. Techies, open source tech, even skeptics, longevity, market cap demand attention, talks about Bitcoin as the shift from physical to digital money, like other dematerialization trends Saylor often discusses. Contrasts Bitcoin with altcoins, highlighting Bitcoin's simplicity, security, first mover advantage, digital gold status, network effect.
What about scale? Does it put Bitcoin's size in perspective?
Yeah, notes that even at roughly $1.9 trillion market cap, it's still tiny, like 0.2% compared to the estimated $900 trillion in global assets. Suggests huge room for growth.
Right.
Frames Bitcoin as a movement, too, at the Ocho dealers, creating a strong community. Addresses criticisms like volatility, sees it as a feature of youth growth, and energy use. Points to proof-of-work security, growing renewables.
So standard Bitcoin defenses.
Pretty much. And points to positive future trends. Institutional adoption like BlackRock's ETF, tech upgrades like Lightning Network, its role as a potential safe haven asset.
How does the newsletter wrap up its message?
It's basically an invitation for small businesses to join this financial experiment. Predicts growth from more institutions, clear regulations, tech improvements, positions Bitcoin as the premier digital transformation idea, asset, network, brand, commodity, and the newsletter as the guide.
Okay, so bring this all together. What are the big overarching takeaways from this deep dive into strategy and the wider Bitcoin adoption narrative?
I think a few things stand out. One, Strategy's really ambitious long-term play to become a Bitcoin bank using unique capital market strategies.
2, the huge potential upside tied to that vision, but also the significant risks which are fundamentally tied to Bitcoin itself succeeding.
3, This broader movement, highlighted by the newsletter, trying to bring Bitcoin treasury strategies to the massive small business sector globally.
which could dramatically widen Bitcoin's integration into the economy if it takes hold.
Exactly. It's like a top-down approach from strategy and potentially a bottom-up movement from small businesses.
So, a final provocative thought for our listeners to chew on. What happens if these two trends really converge? A major public company pioneering the Bitcoin treasury and potentially millions of small businesses following suit.
How could that convergence reshape global finance over the next decade or two? And what role might digital assets, specifically Bitcoin, play in your own financial thinking looking ahead?
Definitely worth pondering. We'd encourage folks to check out the sources if they want to go deeper. The Bitcoin Doctor newsletter, info on strategy, explore for yourself.
It's a space that's changing incredibly
No
fast.
kidding. Staying informed, thinking critically, it's essential. Thanks for taking this deep dive with us today.